Welcome to the Chartered Financial Analyst Level 1 course, and as usual I provide an introductory slide about myself, qualification and experience. Today we will continue with the topic of corporate finance and equity, and this is the video number 4. Within the corporate finance and equity, the topic today, after we finish the corporate governance, we will start a new topic, that is the capital budgeting, and this is the first video in the capital budgeting, although this is the 4th one in the series. First, we need to explain exactly what we mean by capital budgeting. This is a small definition about the topic, which basically says that it is a process. It is not about just deciding what to do about investment. It is a process that follows certain steps, the purpose of which is to decide on capital project. And what is meant by capital project? It means projects that last for more than 1 year or have a useful life of more than 1 year. We will cover 3 topics in this area. The first one is the capital budgeting process. As I just mentioned, it is a process. It is a process. Process means it follows certain steps. Step 1, 2, 3 until taking the decision whether to take the project or not. During this process and the different steps involved, we will reach a conclusion whether the project is feasible, viable, or it may not add value to the company, and we don't go with it. The second topic we'll cover is the principle of capital budgeting. There is 13 principles that we need to observe while evaluating many projects or many investment opportunities. And finally, investment decision, how to take a decision, what criteria we use to decide whether to invest or not to go ahead with the project. Let us start with the first topic of capital budgeting process. The first thing in the process, we need to do what can be described as brainstorming. That is, those involved in the process will come up with ideas. They will search for viable investment opportunities in the market, and based on certain studies, they will come up with many ideas. They will exchange these ideas among them in what can be described, as I said, brainstorming. Then comes the next step of analyzing individual proposal. These ideas represent proposal, 4, 5, 6 proposal. We need to analyze each proposal using certain principle and criteria to decide which one to take. If at all we need to go ahead with one of them, or possibly we will go with more than one proposal depending on the availability of financing and other criteria, which we will come and discuss in details. The second thing is planning the capital budgeting. The planning process involves the target market, the target projects, how to finance this project, whether to take equity or to issue new debt. There's so many planning process goes into this. And finally, we implement or take the project, monitor the progress of the project, and the post-auditing means after we finish the project, we keep evaluating the result and give feedback to decision maker so that we learn from experience, and the next project we know exactly what is required, and we have been through the process before, and we keep learning, and the curve of learning or the learning curve goes up, and we master the process. Normally, new projects can be classified in many ways. The project could be a replacement of an existing asset that is due to wear and tear is no longer usable, or due to new advanced technology, we need to replace the old asset with a new modern one. The second category also could be an expansion projects. So projects meant to expand our current reach, like for example, we could go to new markets or grow within the same market. The expansion could be organic, that is, we grow internally, we expand our own project, which will take time and it will be a lengthy process. Or the project could be by acquiring an existing company. That way we made a very fast expansion. Or it could be the projects we are undertaking could be only a new regulatory requirement. Certain regulation relating to safety or environment might be enacted, new laws that require companies to do some certain thing. That is, in essence, the types of projects we involve in. As I said, it could be a replacement project of an existing asset, or it could be expansion in our own market, or regional market, or even international. We could also have projects to introduce new products. For example, Apple company, if it issued, for example, iPhone 13, they also start immediately into new spending for research and development, so that can introduce new product more advanced, and the process is ongoing. The second topic is the principle of capital budgeting. What we mean by principle, that is rules or regulation or the theories that governing the process of evaluating the project. The first one, decisions are always based on cash flows. It is not based on accounting profit because of many reasons. We will come to this at the time when we evaluate individual project. We will see why we are taking only cash flows. If there is any expenses that is non-cash or revenue that is non-cash, we should exclude that from our calculation. So we use only the cash flows. The second principle is the timing of cash flow. That is very crucial because a dollar, as we all know, a dollar today worth more than a dollar in 2 years or 4 years or even 5 years. Why is that? Because if I'm going to receive a dollar today and I have the opportunity to invest it, possibly after 5 years, I might gain a return of 50%. So I will end up having $1.5 instead of $1 after 5 years. So we can say the 1.5 is the future cash flow. Its value today is $1. That is, we discount the future expected. We always use the word expected because we are not certain about the amount. Expected future cash flows has a value today less than its value in 5 years, as I said, because we could have invested this money if we had it now, or even because of inflation. Inflation erodes value of the money. We will all discuss this later. Cash flows are based on opportunity cost. If you are going to invest in certain project and you expect to get a return of 10%, is there any other opportunities that you can use this fund which fetch more than 10%? If the case, then we should always use the opportunity cost to evaluate current projects. If it turns out that the project is not viable because it has a return less than the opportunity cost, then I will go for that opportunity instead of the current project. This is what is meant by opportunity cost. Cash flows are analyzed on an after-tax basis. We always take the cash after taking into consideration the tax payable on the project. This is why in many equations we find this bracket 1 minus t. T refers to tax. So If the tax is 35%, that means 1 minus 35% will give 65% or 0.65. If we multiply that by the cash, we get a figure less than the cash itself. Financing costs are ignored. Why we ignore the financing cost? That is interest payable on the loan, because this is already embedded in the discount factor. As we know, we use the weighted average cost of capital as a discount factor. That weighted average cost has in it the cost of debt, that is the financing cost. So there will be double calculation if we take again the interest expense that as a cash outflow to the lender. We ignore that. If it is being deducted, we add it back to the equation. Then the capital budgeting cash flows are not accounting net income. Why? Because in accounting, we charge many non-cash transactions such as depreciation, amortization. And why we don't take the depreciation into account? Because when we calculate the cash in, we also put the cash out. If we invest in a company, buying an asset, that asset is taken as cash outflow in the first year of the project, which I paid to acquire the asset. So if I deduct the depreciation, that means again I'm deducting the amount of the initial outlay. That is the first money I paid to acquire the the asset. So there will be also double counting. So capital budgeting concept. What is the difference between principle and concept? We can say capital budgeting principle and capital budgeting concept. Concepts are general ideas we need to take into consideration. Let us see, we will see the difference. Sunk cost. A sunk cost is a cost that has been already incurred and it has no relevance to the decision beforehand. Now, if I incur a cost, already pay it and becomes history, I should not take it into consideration while evaluating whether to take the project or not, because this is irrelevant. Whether you take the project or not, it is already done and it is already paid. So sunk costs should be ignored as well as the financing cost. Opportunity cost, just I explained this, what is meant. We should always use opportunity cost to evaluate our project, because if there is a good opportunity that obtains higher returns than the current project, then that opportunity should be taken, not the project. Incremental cash flow, that is cash that is being generated due of taking the project. Without taking the project, these cash flows will not flow to the company. So this is what is meant by incremental. Externalities means it looks like or resemble the side effect of medicine. You take a medicine to cure certain diseases, but it causes side effect also. Externality are the side effect of taking the project. Here there is example of sales cannibalization. What is meant by that? If the project increases the sale in one section of the company and decreases the sale in the other part of the company, if you have two sections, section that sells in country A and the new project will sell in country B. If taking the new project take out some sales from A, this is called sales cannibalization, which also should be taken into account, because otherwise you will exaggerate or overstate your cash flows, because you take the old sales and the new sales, add them together, which is wrong. You should take the old sale minus sales that has been taken away by the new project. Conventional and unconventional cash flows. Conventional cash flows is normally in the first year you pay a huge amount to acquire the asset. In second year, third, fourth, all the subsequent years, you get cash inflow only. This is the conventional one. The unconventional one, you find some negative cash later during subsequent years. For example, in the first year, you pay negative cash outflow to acquire the asset. The second year, you'll get a positive cash flow. Third year, positive cash flow. Maybe in the fourth year, you expect negative cash flow. This is unconventional, and it creates some issues with the net present value calculation and IRR. This is not the topic for today. We will come to this later on. Independent versus mutually exclusive project. What is meant by that? If there are two projects that are independent, you could take both of them. If we have A and B, project A and project B are independent, then you could take both of them if you have enough financing. But if project A and B are mutually exclusive projects, that means if you take A or B, the other project you cannot take. For example, if I have a land, there I can have two projects, either build a hospital or build a residential compound. If I build a house, a hospital, then I cannot build the same compound in the same land. This is the difference between independent project and mutually exclusive projects. Project sequencing. That means you put many projects in sequence. That means you take the first one. If you have a positive result after 1 year or two, then you take the second one. If the second one also tends to be promising, then you take the third and so forth. This is what is meant by project sequencing. We have to take that into consideration as well. Unlimited fund versus capital rationing. Unlimited fund, that means the company has a slack of liquidity. It could also issue new equity. It could borrow also. This is called unlimited funds. So if you have 5 projects, you can take the 5 of them. But if there is capital rationing, that means capital is not available always. If you have 3 projects, you have cash or financing available only to 1 or 2 projects, but not all the 3. This is what is meant by unlimited fund and capital rationing. I think with this, we come to the end of the first video on the topic of capital budgeting. And this is the video number 4 in the series. Please do subscribe so that you get notified whenever I send a new or publish a new video.